Materiality in accounting is one of those concepts that, while it might seem dry at first glance, is absolutely crucial in the world of financial reporting. Imagine you're an investor trying to make decisions about where to put your hard earned money. You pick up a company's financial statements, but if those statements don't accurately reflect the reality of the business, you could end up making a decision that costs you dearly. That's where the materiality principle comes into play. It's all about ensuring that the information presented in financial statements is relevant and significant enough to influence the decisions of users like you and me. So, what exactly does material mean in this context? In simple terms, an item is considered material if its omission or misstatement could sway the judgment of someone relying on those financial statements. For instance, let's say a company has a massive debt obligation. If this information isn't disclosed, it could mislead investors into thinking the company is in a better financial position than it truly is. On the flip side, if a company experiences a minor fluctuation in revenue that might not be material enough to warrant a detailed explanation, it's all about context and significance. Now, let's break this down a bit more. The materiality principle isn't just some arbitrary rule, it's a guiding light for accountants and financial professionals. It helps ensure that financial statements are not only relevant, but also reliable. When financial statements focus solely on material information, they reduce the risk of misleading users. That's crucial because investors, creditors, and other stakeholders rely on these documents to make informed decisions about a company's future. Determining what is material isn't always straightforward. There's no one-size-fits-all approach. Instead, it requires professional judgment, and several factors come into play. First, there's the size of the item relative to the overall financial statements. A $1 million expense might be material for a small startup, but could be considered immaterial for a Fortune 500 company. Next, we have the nature of the item. Some transactions are inherently more significant than others. For example, a lawsuit against a company could be material due to the potential financial implications, even if the actual dollar amount involved is relatively small. Industry context is also vital. Some industries have higher standards for what constitutes material information. In tech, for example, rapid changes in revenue can occur, and what seems like a minor adjustment might actually be a significant indicator of a company's health. Finally, we must consider the needs of the stakeholders. Are they sophisticated investors who can parse through complex financial statements, or are they everyday individuals who need clear, concise information to make decisions? Let's take a moment to think about why this is so important. Imagine a scenario where a company fails to disclose a material liability, like an impending lawsuit or a significant debt. Investors might think they're making a wise investment based on incomplete information, only to find out later that the company is facing serious financial challenges. This kind of oversight can lead to disastrous consequences, not just for investors, but for the company itself. Trust is at the heart of financial reporting, and when that trust is broken, it can take years to rebuild. Now, let's explore some examples to illustrate how the materiality principle is applied in real-life scenarios. Picture a company that buys a low-value asset, say a dustbin, for $5. Now, should this be expensed immediately, or should it be depreciated over its useful life? For a small company, that $5 might be material, and expensing it immediately could skew the financial picture. However, for a larger company, it's likely immaterial, and they might choose to depreciate it over 5 years, which would provide a more accurate representation of their financial health. On the other hand, consider a company that has a small liability due in 6 months. If they choose to expense it immediately, their current period net income would take a hit, potentially misleading stakeholders about their financial health. Instead, accruing the liability over the next 6 months would provide a clearer picture, showing investors that the company is managing its obligations responsibly. Another example could be a company that incurs various small expenses, like telephone and stationery costs. Should they merge these into a single miscellaneous expense account or track them separately? If these expenses are immaterial, merging them might simplify accounting. But if they're material, separate recognition provides more transparency and helps stakeholders understand where the money is going. The materiality principle also interacts closely with other accounting principles, like conservatism and full disclosure. The conservatism principle suggests that accountants should err on the side of caution when making estimates, while full disclosure emphasizes that all relevant information should be presented in financial statements. Materiality acts as a bridge between these principles, guiding accountants on when to disclose information and how to present it accurately. Now, let's talk about the role of auditors in this whole process. Auditors use the concept of materiality to determine how much testing they need to conduct and what level of evidence they need to gather. They assess the risk of material misstatements in financial statements and decide how much scrutiny to apply based on the materiality level. For instance, if a company has a high risk of misstatement in a particular area, auditors will dig deeper, gathering more evidence to ensure everything is accurate. Setting performance materiality is crucial here. This is the maximum allowable misstatement in the financial statements that won't significantly impact the decisions of users. Specific materiality, on the other hand, refers to how much an individual item can be misstated before it becomes a concern. This nuanced approach allows auditors to tailor their testing to the specific circumstances of each audit. As we wrap up this discussion on materiality, it's clear that navigating the fine line between material and immaterial items in financial reporting is no small feat. It requires a delicate balance of professional judgment, an understanding of context, and a commitment to transparency. The materiality principle is not just a guideline, it's a fundamental aspect of ensuring that financial statements serve their purpose to inform and guide users in making sound financial decisions. In a world where information is abundant but often misleading, the materiality principle stands as a beacon of clarity. It helps us sift through the noise and focus on what truly matters. Whether you're an investor, a creditor, or just someone interested in understanding the financial landscape, grasping the materiality principle is essential. It empowers you to make informed decisions and navigate the complexities of the financial world with confidence. So, the next time you pick up a financial statement, take a moment to consider the materiality of the information presented. Ask yourself, what's significant here? What could influence my decisions? By doing so, you'll be better equipped to understand the financial health of the companies you're interested in, making you a more informed and savvy participant in the world of finance. Thank you for joining me in this exploration of the materiality principle in accounting. I hope this discussion has shed some light on its importance and how it impacts all of us in the financial ecosystem.